Hello, and welcome to Loyola Marymount University. My name is Dennis Draper, and I'm the Dean of the College of Business Administration. Each year, we are fortunate to bring in a number of prominent business executives and special guest speakers to participate in our CBA lecture series. From high-ranking government officials, to leading journalists, to internationally acclaimed social entrepreneurs. All of our distinguished speakers share one common goal: to educate our students and local community on some of the biggest issues in global business today, all while reinforcing LMU's underlying mission of teaching business with ethics and social responsibility. Thank you for watching, and I hope you enjoy the presentation.
Ladies and gentlemen, I'm delighted to be here at Loyola Marymount. I'm delighted to be in LA. I want to share, usually when I come to California, I go to the northern part of the state because we have, our daughter has been a student at a different university up there. And in that part of California, the name Steve Young carries something with it. And so it was a number of years ago, and I was at a drugstore in Berkeley, and I'd bought my shaving cream or something like that. And for some reason, you stood at a sort of a higher place here, and you put your purchases down below, and there was a shelf, and the young lady was down there where she would ring things up and then hand it back up to you. I never quite understood that. But anyway, so I put my shaving cream and things down there along with my credit card. It said Steve Young on it. And so I'm sort of looking at this, and this young lady, without looking up at me, picks these things up, picks up my credit card, looks at it, and her hands start to shake. I mean, the man has walked in, right, to her store, and she is about to meet, someone who at least can throw a football. And then she looks up at me, and the combination of anger and resentment and surprise in her face was not something I want to experience again. So I apologized. I said, I'm not that Steve Young. But that sort of goes to the point of our appearances reality. What I would like to do is share some thinking with you that we've been evolving at the Caux Roundtable. And the context I would like you to have in your mind in my remarks is what is going to happen in our country and to our country tomorrow. If the results come out more or less as the polls predict, we are going to be a very split people, unable to make up our minds as to some basic direction that our government and our community ought to be going. And that should be a sign that we need intellectual leadership. Because if people don't really have an idea as to where to go or what to do or why things are happening, you kind of freeze, and you're uncertain. Of course, in the book of Proverbs, it says, "Where there is no vision, the people perish." So the obligation, I think, turns away from our political leaders to people like ourselves, in nonprofits like the one I'm involved with, or to people in universities, whether you're students or faculty. What is, and I may be a little bit abstract in my presentation, but what is a conceptual framework that we can apply to give us a sense of commitment and energy? Now, as Marx said in a thesis on Feuerbach, I think number 19, up to now, philosophers have only interpreted the world. The point, however, is to change it. Now, Marx went on to develop a whole theory based on materialism, which understated the role of values and ideas. I come from an intellectual background which is very anti-Marxist, very much influenced by Max Weber, and a notion that ideas and values are profound drivers. If we get our ideas and our values right, then there are higher odds that our behaviors will be successful or relevant or consistent with the way things are going in a constructive way. Now, I believe, and I want to present to you tonight, I believe that there is a way of thinking which has shaped our thinking about finance and business, which has misled us. And that way of thinking you can link directly to the behaviors which caused the collapse of credit markets in 2008. So I think an alternate theory, an alternate approach is recommended, is needed, and I want to suggest, if I may, some outlines of that. But before I start, rising from the ashes. I think we have maybe in our desire to move forward, we have overlooked the seriousness of what happened in September and October 2008. From one point of view, is that the financial institutions in the architecture, quote unquote, Wall Street, which made the United States of America the great economic power that we were and perhaps may be again. These are the firms and everything, Goldman Sachs, Lehman Brothers, JP Morgan, Morgan Stanley. I mean, they put together and financed United Steel, right? All the great American corporations, which created from the 1880s, 1890s, down through the 1990s, the great American companies and even some smaller companies. They put capital into smaller companies. Okay, Palo Alto and all the financing and Silicon Valley financing and all the Silicon Valley companies, the new giants, Google, et cetera, et cetera. Similar model. That model self-destructed and committed suicide and died. In 2000, it died. None of those investment banking firms survived. What did they had? They had to convert themselves into banks so they could go to have the Federal Reserve Board stand behind them. They destroyed themselves. The classical model of investment finance, which built our country, self-destructed. And I think we have to recognize it was a self-destruction. And I quoted Karl Marx before. It was not the communists that killed Wall Street. Wall Street killed itself. And here we are 4 years later. And have we resurrected it? Has the phoenix arisen from the ashes? Now, this is a chart from the Federal Reserve Bank, which is, I think, the only chart you need to understand what we did to ourselves. Okay, this is the total credit market debt of the United States as a percent of GDP. So this line here represents total credit market debt, private sector, and public debt that was sold into the markets, which is a large part of our public debt, federal, state, local. Does not include the implicit debt or the implicit obligations of Social Security, Medicare, Fannie and Freddie's guarantees and stuff like that. Okay, this is 1922. This is March 2008. This is the aftermath of 1929. This is the Great Depression. I'm told that this spikes up here not because our debt increased, but because GDP dropped. So the debt stayed about the same, but GDP dropped. So the capacity of the country to pay off the debt was not so good. So this spikes at 255% of GDP. May I suggest, ladies and gentlemen, that another very interesting part of this graph is right here. That's World War II. World War II, we had 16 million, roughly 16 million men under arms around the world. We had borrowed to the hilt. We had war bond drives. Any way we could finance this war, we were financing it. We had huge amounts of debt. GDP was going up because everybody was working in factories. We defeated the Nazis and the Japanese militarists, and basically we didn't break 160% of GDP. This is 350%. What did we get for all this debt? Secondly, right here, that's 1980. May I suggest that something dramatic happened in our country in 1980? Statisticians and chartists will say this is an inflection point, right? Something changes to the curve right here. It becomes exponential, it becomes geometric. Something radically changed in our appetite, our collective appetite for debt. This is a different chart of basically the same phenomenon from a different source. So the curve is roughly the same. 1980 is right here. This breaks out the debt into different sectors. And when many times I show the first chart, And people on the left get excited, and they say 1980, absolutely. Ronald Reagan, the Republicans, removing the restraints on business, liberalizing things, going to a free market economy, that's what got us into trouble. And also, the conservatives, 1980, after that, it was that growth in federal debt. It's all those Democrats piling up the debt. That's what got us into trouble. Okay, ladies and gentlemen, this is state and local government debt. Pretty much good. This is 1946, okay? This is federal government debt as a percentage of GDP, okay? You can see in 46, at the end of World War II, what a lot of debt the federal government had. That's debt we accumulated to finance the war. This little tiny little orange thing right here is finance. That was Wall Street. That was the Wall Street that made the American success possible, and basically no debt. This purple section here is non-financial industry. Pretty much straight line. Okay. Federal government actually shrinks a lot, shrinks down here, builds up under late Reagan, George H.W. Bush, shrinks under Clinton, expands again under George W. Bush. The yellow is households. That's us. That's second mortgages, that's credit cards, that's all this sort of stuff. And it tends to be the same, but here it begins to grow. This is the financial sector. When the financial sector began to turn from individual partnerships to publicly held firms, which then sold stock and borrowed debt, and when the business model of Wall Street began to shift from making fees by arranging mergers and acquisitions and things like that to investing, proprietary investing, right? They needed debt to make the machine work. And this is the debt boom here. Okay, what happens when you have too much debt? What happens to prices? Do you get good pricing? Okay, this is the home values, right? This is what we went through. Boom, crash. So, whoops, I thought there was another slide. I'm sorry. I thought I had another slide in here, which is a slide of, median income. Let me do this one. Okay, median income of a full-time working male in the United States of America peaked in 1973 and flatlined. Median income for full-time working males in real terms has not basically increased since 1973. It's 40 years. And we wonder what happened to the middle class. Now, median family income rises up, not spectacularly, but it rises up. But we have two things. We have spouses entering the workforce in this period in large number. And we were able to keep up our lifestyle through what? Debt. Okay, so what insight can we really draw from this experience of too much debt and the asset bubble and the collapse? Let me suggest that markets misprice. If markets do not, and I will talk about this, if markets do not reliably price, how can we trust markets? How can we just let business people do anything they want? The theory, which I want to talk about and then critique, is a theory of sort of market rationality, market perfection. Now, in the first situation, when there's trading and speculation, which is what we had in the bubble, you don't get good pricing. It's just, I'm going to argue, and I'm a lawyer, by the way. I'm not a deep financial thinker or an economist, but the data, and this goes back to the speculative markets, back to the tulip crisis in 1626. John Maynard Keynes fundamentally talked about trading and speculation markets as what they call the prettiest girl contest. Apparently in the 1930s, in the newspapers in England, they used to run contests. And if you could pick the prettiest girl, you'd get money. Now, what was the prettiest girl? They'd have a picture of, 6, 8 girls. But the way you won was you had to pick the girl that the majority of the readers would send in and say she's the prettiest one. So your speculation was on what other people thought. Let's assume one of the girls was a redhead. Let's say if they had colored pretty men. Let's assume one of the girls was a redhead, and you like redheads. So you would immediately vote for her. She's the prettiest girl. You would price her very highly, and for you, it was a high price. Redheads are your preferred appearance. But a lot of people don't like redheads. Bad luck. So if you want to win the contest, you don't vote for the redhead. You do something like you say, most people out there, and it's mostly guys who are going to be doing the voting, you think, but what if it's women who are voting? Oh my goodness, complications. But most guys like blondes, right? So you want to find the blonde. But now wait a moment. You have to guess what the other people, what if everybody out there is thinking the way you are? And they're thinking that everybody's going to vote for the blonde, so they vote for the blonde, so you better vote for the blonde. But what if there's some trend because there's a new movie star, Audrey Hepburn, or somebody who's a brunette? How are you going to solve this problem? What you were doing, according to Keynes, is you were entirely gaming the outcome on what other people think. You're not looking at fundamental values. So the issue I give you in the same vein recently was the IPO of Facebook. How much is Facebook worth? 50, 100, 75? Is Facebook worth $94 billion? Gross income, what in the end of 11 was like $3 billion. Net was something like 1 point something. Facebook deserves a multiple off net of 50, 60, 70, 90. They don't even have a business model that seems to be able to generate sufficient cash flow. And you're going to put a huge multiple on it? Well, but if everybody else in the market thinks that Facebook is the next Google, hey, why not buy at 45? Because it'll jump up to 60 or 70. Well, what happened on the day that the stock was offered? No jump. Right? It was offered at 32, goes up to 45. End of the day, it's back at 32, supported by the investment banks who are pushing it. Now it's at 21. Trading and speculation is all about what other people think, not necessarily true underlying value. Okay, another area, well, also financial markets. Something that it's not, I don't think, talk about. What do we buy in financial markets? Basically, all we buy are pieces of paper. What is a stock certificate? What is a bond? What is a derivative? What is a CDO? What is a CDS? These are merely pieces of paper with legal rights spelled out and drawn up by lawyers. There's nothing real about a piece of paper. It's just a legal contract claim. And the marginal cost of issuing an additional piece of paper is basically almost nothing. If I've done one very complicated CDO offering for Goldman Sachs and I have all those documents in my computer and I have to do a second one, what's the marginal cost? It's basically a couple of days' work for a lawyer. Then I press a button on the computer and the darn thing spits out and we make 50 copies and we pass it around and we just created a new $1 billion worth of wealth, quote unquote. So we have basically marginal cost of supply and contract rights and infinite elasticity of supply. We can pump these things out as long as there's demand. So if there's excess liquidity and a whole bunch of people out there who believe in the value of these things, we can just keep pumping them out and we build a bubble up. Our pricing is it sound, is it reliable? Next, there's another area, rent extraction, where markets don't price very well. This is crony capitalism, this is corruption, this is monopolies. This is where you get a special deal and you can price above real market pricing. And the third area is externalities. Market prices is a classic example in economics and elsewhere. Market prices do not take into account either future costs of pollution or negative consequences for people or positive things. If your product is good, if you make some product and let's say you could have a material impact on reducing global warming, which is going to help humanity, how do you charge for that? That value to humanity, that public good which is out there across billions of people, you're going to charge them all 2 cents? How are you going to collect it? So markets don't price that very well. So I suggest we got some problems with pricing. So the theory of trusting markets, I would suggest, is not adequate. What they give us, let me make a distinction here. Short-term rationality. Market price today is a rational price for today. Given all the information, this is the efficient market thesis, all the information we all have today and what our preferences are. If we all think Facebook is worth $94 billion, then that stock, at that moment in time, we can say, yes, it's rational that that stock is priced at $45 or whatever it is. Well, what if tomorrow we change our minds? The market price has to change. So to what extent is today's market price effectively connected to tomorrow's market price, or next week, or next month, or next year? So we have a certain kind of short-term rationality. But how many times, as in asset bubbles, as with subprime mortgages and many other things, short-term rationality can be long-term irrationality? So what is rationality? Well, how do I want to use the term rationality? I want to use the term rationality in terms of its seeking an end, teleology. This is an old concept, moral concept, no, Aristotle talked about. We human beings, we seek ends, we seek goals. We have a telos. We seek things. I want to make money. I want to go swimming. I want to get a new car, right? And rationality is, how do I go swimming? How do I take action to go swimming, to get a new car, to make a lot of money? How do we get from here to there? How do I get what I need or want, right? Now, also part of rationality is some notion of science of causation. What makes things happen? That reminds me of a joke of Adlai Stevenson back in the UN, but we won't go there. It was too long ago, 1962. Okay, how do things happen? If I want outcome X, what do I have to do? What influences it? Right? If I want to buy a car, I'm going to need money. How much money? Where am I going to get the money? Right? I borrow some, I have some of my equity, I sell the old car. I got to put things together in a way that in the real world, in the material world, gets me to where I want to go. But another point about rationality is what we seek tends to drive what we do. Our goals, our objectives, our telos has some very close connection to what we do. So what about short-term rationality? I want to argue that the drivers in the short term for us, right? Fear, greed, and anger. And a lot of business and market behavior plays off the greed and fear of other people. If I know your fears, if I know what you hunger for, I gotcha. I can take advantage of you. I can give you a product. I can manipulate the price, whatever, right? And short-term rationality, I think, is very much about protecting the self. Short-term self-interest. We stay close to home. And it's very much related to the old flee or fight syndrome that our ancestors had. And it's the kind of rationality that it tends to exist in the lower part of the brain, what some people call the reptilian brain, the ancient brain, which is protecting us. It's not the prefrontal cortex where lots of thought is. And a lot of short-term rationals, a lot of short-term, if you think about somebody who's short-term thinking, you say that's not very smart or wise, what are they probably doing? They're probably working from emotions. I'm angry, I'm jealous, I'm this or that. Many times the short-term rationality, we base it on our conventions, our instincts, our suppositions. I've got to make a quick decision, I have a quick reaction, I act on it. What do we say? I don't stop and think. But we also have we have some good things, I think, which show up in the short term. We have people's reaction is out of courage, honor, love. I'm going to do this. I'm going to stand here. Long-term rationality. What drives this? Things which have been talked about by Aristotle in particular and many other people, Thomas Aquinas. Prudence. The notion of self-interest considered upon the whole. I think into the future. I think broadly. How am I maximizing my interest over the near term, the long term? I can do something today, make some money, have fun, take advantage of somebody, but geez, if I think about it, it's going to come back to bite me, as we say. I'm undermining kind of my own position down the road. I need to be prudent and responsible today in order that I get a stronger, safer, or better position in the future. A classic example of this is savings. Right? Why do we save? We sacrifice today because we have we think it through that if I put all this money away at some point in the future and if it has compound interest and I keep it there long enough, Turns out to a lot of money, and then I can use it to buy a house, buy an engagement ring, or whatever. I saw the other week in Bloomberg Business Week a statistic. Any of you happen to see it or know based on some kind of survey, the percentage of American youth who are saving their weekly allowances? The number of American youth today who are saving. 1%. Right? So that means we're raising a generation of Americans, 99% of which, young kids, no experience in saving, no understanding of saving. Okay, our risk management with long-term rationality is more sophisticated. We seek allies, we do this, we bob and weave, things like that. We reach out to a wider range of consequences and probabilities. And most importantly, something called the moral sense I'll talk about. We engage the moral sense. We engage some notion, right, wrong, ethics, other people, long-term. What's the honorable thing to do? Okay, but it's this short-term rationality that drives our theory of markets, which drove the notion of efficient pricing, rational markets, and Alan Greenspan's belief when he was head of the foreign, let the markets do what they want. They're smart, they're rational, they won't make mistakes. They're checks and balances. The technical term, you may have heard of homo economicus. It's a notion that's defining we human beings as being fundamentally self-interested, short-term oriented, in terms of sort of cash, money, and profit, and self-advantage. Basically, we don't think about other people. We don't think about morality or ethics or the good of society or the family or whatever it is. It's all about us in the short term. And so market rationality is competition of self-seeking, profit-minded individuals. And the assumption is this brings optimum outcomes. And I think the refutation of this theory was Wall Street 2008. This is what we set up. We deregulated the industry. We allowed people to act this way, and what did they do? They tanked the American economy and they tanked the global economy. Totally irrational, in the long run, totally irrational behavior. Okay, so there's something called the agency theory, or the agency problem, which a lot of scholars have talked about as a reality out there. If we use short-term rationality, basically we're bad agents. It's a theory about being bad agents. It says basically we can't trust anybody. No one can be faithful or loyal. And just think about this in the context of your interpersonal relationships. Those of you who now have or have had significant others. This theory basically argues that any of these relationships are just mutual exploitation. And he or she is a fair weather friend, right? And he or she is always interested in what's in it for them. Now, we all know there are a lot of people who really are like this, right? And a lot of relationships are based on this. But this is good for us. This is what we want. This is what we like. In business, the rule of conduct is take the money and run. The principal analysis, you want to figure out what's going, just follow the money. You want to understand why Wall Street imploded, just follow the money. Who got the fees, who got the bonuses, who got the commissions? And Wall Street was, you take the cash out and you run, and whoever got stuck with this stuff, the toxic assets. Any of you remember the article that Greg Smith, he now has a book out about why he left Goldman? He had this article in the New York Times, I think in March, about what Goldman insiders apparently call their clients. Did you all see that? Muppets. Right? You push the bad stuff out on the Muppets because they're not smart enough to figure out what they're really buying. This is what we want in financial circles. And the bigger theory about this is social Darwinism. Survival of the fittest. Because the devil is going to take the hindmost. Some of you may know this book. If you want to figure out how to live your life by this, get Robert Greene's book on the 48 Laws of Power. It sold over 1 million copies, I think, of the year. It's 48 rules about how you can dominate, fool, lie, cheat, and steal other people. Boss them around, trick them. It has rules, and he takes this from people like Machiavelli. He's gone through all these great stages in the past, gets all these rules about basically how to come out the winner. Like one of the rules is something like, the first thing you do is make pretend that you're a friend. Okay, now Amartya Sen talked about this agency problem, okay? Can you direct me to the railway station, asked the stranger. Certainly, says the local, pointing in the opposite direction towards the post office. And would you post this letter for me on your way? Certainly, says the stranger, resolving to open it to see if it contains anything worth stealing. Right, each of these people are operating on the agency theory, short-term rationality, taking advantage of each other. End result is nothing good happens, right? The guy doesn't get the railway station, the other guy loses his letter, it doesn't get posted. So now the question is there a reality behind this theory? Now, Adam Smith is very famous when he talks about self-interest in Wealth of Nations. I'm not going to read all this, but you can look it up. But basically, Adam Smith and he's been blamed by this for many people. He says, basically, I depend for my dinner not on the Christian love of the butcher and the brewer and the baker for me, but on their desire to make money, self-interest. And he talks about most people, if I can get you to see your advantage in doing something that's important to me, you're more likely to do it than if I say, please, please, please. But what both of these things mean, which I think many have overlooked, is the inference. We got to understand other people. I'm not going to be able to buy the bread or the beer or the meat unless I meet the seller's price, right? I got to understand the other party in this relationship. If I'm going to get you to do something for me because it's going to help you, I got to figure out what you want. What do you believe in? What do you care about? I have to have some kind of moral relationship with other people in order for these transactions to take place. Market transactions, according to Smith, are not fundamentally exploitation. Okay, so but if we believe in this, no faithful agents, no faithful stewardship, no win-win collaboration, you can't rely on anybody, you want to motivate people, it's all about cash rewards or punishment. This is the basic theory of CEO and executive compensation these days, by the way. And business goals and objectives, you just report financial metrics. That moves stock prices. Focus on quarterly net income. Don't worry about customers, don't worry about the environment, don't worry about the community. Focus narrowly in on self-interest. Smith also pointed to a problem. There is a problem. It's called other people's money. When you talk about companies, when you talk about people who manage other people's monies, Smith noticed back in 1776, and it was true for Wall Street today, that people are more negligent when they're managing other people's money than when they're managing their own money. That does seem to be a fact. So what do we do? Now, I don't want to go through this. It's a long list, but I want you to have a sense that there are big issues here. A theory such as rational market theory or agency theory is not going to have the hold over our thinking and our education unless it fits with a lot of philosophy and a lot of thoughts that many, many people agree with. And we've had a couple of things. There's one tradition of natural law. You can start with Hobbes. You come down through Jeremy Bentham, Herbert Spencer, come all the way down. There's William Graham Sumner, was a social Darwinist who wrote around 1900. You can read Sumner's articles and it reads like a Ronald Reagan campaign speech or a Mitt Romney campaign speech. These ideas have been around for a while. Berlin Means, 1932, very famous. They pointed out that the managers of corporations have more power than the owners. And managers can serve themselves and not the owners. Ayn Rand has her own philosophy of libertarianism, which reflects this. It's all about me, if you read Ayn Rand. And she has influenced Alan Greenspan and Paul Ryan, our vice, right? If the Romney-Ryan ticket gets elected tomorrow, we will have as our vice president somebody who believes in this theory. Out of this comes game theory, microeconomics, and the agency theory. There's another train of thinking that comes down, which I call state of nature thinking. Starts with Jean-Jacques Rousseau. This is, we're all sort of natural savages. We look at human beings in our natural condition. Rousseau thought that human beings, natural savages, were wonderful, helpful, altruistic people. And that what corrupted us was society and convention and religion and hierarchy. So what we have to do is get rid of society, convention, religion, hierarchy. Nietzsche in the 19th century takes this and to another point saying there are no values. The only thing there is the will to power. And it is a struggle of all against all. In our law, we came up with legal realism. All the arguments we have about appointing judges to the Supreme Court, the issue is these people don't follow the law. They follow their own ideas. So we have to stack the deck. If we want certain outcomes from the Constitution, let us say on the life issue, we don't just trust people to interpret the Constitution. We got to get people who have an ideology, and we got to get them on the Supreme Court so they vote their ideology, not the law. It's a very cynical belief, which is widespread. Freud, the influence of Freud and the notion of we are driven by deep psychological forces that we don't control. Our rational powers of ego are weak and irrelevant. We're sort of out of control beings. Coming from this, we had existentialism. The 1950s. Existentialism, the notion of there is no meaning to life, right? Norman Mailer has a 1958 essay, very prescient, with an odd and strong and disturbing title called The White Negro, where he talks about the future of the United States. The pathway of revolution in the United States is social pathology. Let's get rid of the moral sense. Let's not be responsible. Let's not have values. Let's not respect our parents. And some of you have lived through the 1960s, and guess what? That's what happened. We now have very sophisticated modern philosophy, deconstruction theory, Foucault and Derrida, which are telling us that everything is just talk. It's all discourse. There is no truth. So if everything's just discourse, why should I listen to you? Why should I bend? There's no truth, there's no authority, there's no values out there. It's just all what I want. And that has come into the law through critical legal studies and the field of law and economics. A lot of heavy-duty thinkers and theories are pushing us in this, have pushed us in this direction. All right, now I want to suggest there's an alternate theory. And this is what I think, it's out there, it's been out there. It needs to be, if you will, found and dusted off. There's a moral sense. And it's the notion, clearly in this notion of moral sense is, do we trust people? Right, the agency theory, agency problem theory says we can't trust people. This says we can trust people because there is something in other people that is trustworthy. Where does that come from? Right? There's a recent, I thought this was a nice quote from a Chinese businessman. Let me read this one. We human beings always seek happiness. There are two ways. You make yourself happy by making other people unhappy, right? I call that the logic of robbery, right? The other way, you make yourself happy by making other people happy. That's the logic of the market. Which do you prefer? He's echoing in his own way Adam Smith's argument. That if I make you happy and you make me happy, we have a deal. We can be partners. We have a trade. You sell me meat, it's good meat. I come back and I buy more. I tell my friends, the best person selling meat is so-and-so. Great, go there. I actually help you gain more business because you gave me good meat at a fair price, you treated me nicely, you considered me as a decent human being, and in the end, your business grows. Okay, let me go real fast through a lot of this stuff because we're running out of time. I want to suggest that there are roots to this moral agency theory that's been around, and some in particular bear a particular relevance to this institution. Okay, there's a Judeo-Christian background to this. Let me reflect Ezekiel 34. Woe to the shepherds of Israel, who only take care of themselves. Should not shepherds take care of the flock? Ezekiel, in the Jewish tradition, is pointing out the need for the possibility of stewards, shepherds. They're there to take care of the flock, not take care of themselves. This is assuming that human beings are capable of being responsible, ethical, moral. They take care of the sheep, right? Matthew 4:4. Man does not live by bread alone. There is something more to us than mere crass self-interest. Whatever that might be, we can discuss. And then Luke, get thee behind me, Satan. Right? Yes, there's temptation. Yes, there's power. Yes, there's money. But I can rise above the temptations. Right? I'm sort of reminded at this point, some of you may remember the tape of Richard Nixon in the White House when John Dean comes in and says, Mr. President, we got a problem. The Watergate burglars, they're going to talk. We need to raise more money for them. And Nixon says something like, how much? And Dean says, we need $1 million. And Nixon is recorded as saying, I know where we can get $1 million. We can get $1 million. There's a long pause, and then apparently he leans over and speaks into the microphone, because he knows where the microphone is, and says in a very loud voice, but it would be wrong. Right? He put temptation behind him. Now, the most recent encyclical by the Pope, Caritas in Veritate, talks about charity, this concept of caritas, charity. Love, caritas, is an extraordinary force which leads people to opt for courageous and generous engagement. Charity gives real substance to the personal relationship with God and with neighbor. This encyclical presumes that human beings are capable of charity. In the Judeo-Christian tradition, human beings, to some extent, are capable of charity. They can be reliable, they can be trustworthy, they can be decent. Now, there's another origin of our sort of theory, which goes back to Roman law and the Stoic philosophy. Roman law had several things, the mandatum, the fiducia, and the fide commissa. Fiducia is where we get the word fiduciary. Fiduciary is the word in law for being a good steward, for being a good shepherd. And then in writings, the Stoic writings, Cicero has this whole book, De Officiis, which means on duties. We use this word officius as office. If you have an office, you're responsible. You have duties that go with office. By the way, the person who gets elected president tomorrow, what is the official act that will make him president? Is it the election? No. It's the inauguration. What's the official act in the inauguration that will make him president? He takes the oath. He assumes the office. And what does that oath say? I will faithfully execute the office of president. Office and faithfully execute. The presumption in our Constitution is that people can be trusted in the use of power of office. Marcus Aurelius' Meditations, the Stoic philosophy, Marcus Aurelius talks about how you look inside yourself for courage, for meaning, for the right thing to do. You don't look to money or other things. Okay, the common law of England merges the two. So we have law that comes down. Accounting. Many of you are accounting. The word accounting goes back to the common law where you have to account for how you have conducted your office. And Justice Cardozo in Meinhardt versus Salmon has this very, very important phrase that for people in fiduciary relationships, agents, by the way, every employee is an agent. We don't teach this in business school. We don't teach it in law schools anymore. Every employee of every other person is an agent to the principal, the person who employs them, and they have fiduciary obligations to that principal. They are supposed to be faithful and moral individuals. That's the law. Do we behave that way? Question. But the way we're supposed to behave is something higher than the morals of the marketplace. By morals of the marketplace, he means dog-eat-dog survival. It's a 19th century case which basically talks about all this in the notion of negligence. We're supposed to sort of think about the consequences of our actions. And if our actions are going to hurt somebody else, a duty arises in us not to act that way. If you're driving too fast at night in the rain and a slippery road, and you might hurt somebody else, slow down. That's your responsibility to be that kind of a person. If you don't slow down, if you use bad judgment and you hit somebody, and they can take you to court and sue you for damages. Where a lot of this tradition has gone is not in business, but in our political tradition. It's the English and American Whig. The Puritans, John Locke, in his second treatise on government, talks all about a trust. Adam Smith wrote a whole book on the theory of moral sentiments. He was an English Whig. We have inside, he called it the man within the breast. In our words, we might talk about conscience. He says that every human being is born with the possibility of having some kind of a conscience, of being aware of other people, of thinking about other people. Washington talked about a union between virtue and happiness. If you want to be happy, you got to be virtuous. Happiness is not about going out, having a good time, getting wasted, and spending 14 hours a day on Facebook, right? Where's the virtue? And duty and advantage. Washington and his generation believed you do your duty, good things are going to happen to you. And his belief was that people could do their duty. Lincoln. How does Lincoln end his second inaugural? Perhaps the most powerful, most important speech in American history. Right? The Civil War is coming to an end. Bloody Civil War. So what does he say? With malice toward none, with charity for all. He's assuming that the Northerners can act this way towards the Southerners. And clearly, charity, this is caritas. Right? With firmness in the right as God gives us to see the right. We have a capacity to see the right. This is Adam Smith. Let us strive to finish the work we are in, to bind up the nation's wounds, to care for him who shall have borne the battle, and for his widow and orphan, to do all which may achieve and cherish a just and lasting peace among ourselves and with all nations. Optimism. Federalists. The Federalist Papers about our Constitution. A key point here of balance. As there is a degree of depravity in mankind, we've got some bad folks out there, which requires a certain degree of circumspection and distrust. Maybe there's a little something to this agency problem that people can't be faithful. So there are other qualities in human nature which justify a certain portion of esteem and confidence. There are some people we can trust. There are circumstances which will make it work. So why should we use this trust theory in our politics and a cynical theory in our economics? Okay, this notion of moral sense, we can go on for a long time. Mencius has a theory of moral sense, Ren-yi in Chinese. In Islam, there's the concept of fitra. God created all human beings with a moral nature capable of understanding God's purposes. Otherwise, why would God reveal the Quran if there are a whole bunch of us, if we can't get our act together and be good, decent people, right? And then Buddhism. Buddhism believes mindfulness, that all of us can improve our mindfulness practice. So if we take the moral sense in business, what happens? A business firm is an office of service to society, not just there to make money. So that leads to a vision of corporate social responsibility. That leads to a concern for different stakeholders, customers, employees, the environment, right? It also means, it implies that private goods, the goods and services that we buy in the market, automobiles, TVs, whatever, food, the private goods many times can have public aspects. The one I've been talking about today is food. Food is fundamentally a private good. It's produced for us by the private sector. There's government subsidies in there, but basically private companies produce food, send it to markets where we all buy it as private goods. What we are learning because of the obesity epidemic leading to diabetes too, is that lots of foods have negative consequences for people. So even though these are all private goods, we're now realizing, as it is with guns, with tobacco, and with alcohol, and with other things, that private goods, under certain circumstances, in certain people's hands, lead to bad consequences. Private goods, do we leave that to the private sector? They have public consequences. What do we do? Regulate? Say you can't sell whiskey? We tried that in Prohibition. Can't sell guns? Should we put a tax on ammunition? In today's New York Times, there's a proposal in Riverside, California, that there should be a tax placed on big soda drinks, which have lots of sugar, which contribute to obesity. We allow the private market to continue to supply these big cups, but we tax it to dissuade customers from buying this and hurting themselves by consuming too much sugar. Externalities. Private markets and firms have to consider these externalities. We have to consider consequences. We need long-term rationality, not short-term rationality. So what does this mean for pricing? Coming back to the beginning. Okay, the best current price is not, I would submit, anything the market says. The best current price is a present discounted value of future earnings, which we do independently of market pricing, right? So that includes future risks and contingencies. Short-term rationality, which says any price out there is a good, fair, and efficient price, take it with a grain of salt, please. Because another reason is for market pricing, I didn't talk about it, is the possibility of black swans, fat tails, or long tails in probability distributions. Right? There are, as a friend of mine in the law faculty used to say, there are potholes in the road of life, right? And we don't always see them in time. So what we need for market pricing is long-term rationality. Thank you very much.
Okay, there we go. So I guess my question was, so you say that this moral sense needs to be involved in capital markets and investing and just kind of our sense of business. But I mean, I guess like specifically, what do you think needs to change in order to, like, what as a business person do you need to do? I mean, if I'm a soft drink person, it's hard for me to say to each customer, like, oh, you should or shouldn't have this next soft drink, or you should or shouldn't have this larger soft drink. I guess it's like, partially, what do you think the responsibility of those business owners is, or what do you think anyone's responsibility as an investor or financer is? And where do you draw the line between what's that business's responsibility and what's a person's responsibility?
You've got a lot of very important questions in there. The first point, the preliminary point, I talk about this in my book, is that for better or worse, I argue that the fundamental provider of morality and ethics for markets are the customers, right? Because a business without customers is broke, is nothing. So you got to start with the customers, because that's where the demand is. So the question then becomes, if we're talking about these things like obesity, I mean, sort of the classic cases, alcohol, guns, prostitution, there are a range of the vices, let's say. What do you do when people have values that either you think are bad values or they are objectively? I mean, they're not good, right? We have lots of guns out in the society with lots of bullets. That increases the odds that people are going to get shot and maimed and killed. We'd be a lot safer if there weren't all those guns and bullets out there, right? But people want to buy guns and want to buy bullets, and we're a free society. So what do we do? We have a whole range of opinions. Some things, marijuana, drugs, right, we outlaw. Lots of issues now about marijuana. It used to be pretty clear for a lot of people. So drug, outlaw it. Now, people's thinking is changing. But let's take the case of food that you raised. What do? You're in the business of selling soft drinks or making soft drinks. Or you're making Monster, right? Or you're selling Red Bull. Or you've got something that you can hype with caffeine or something like that. Should you? People will buy it. You can make a profit. Should you? At some ultimate point, I mean, I think that is something which, in our kind of society, we're not going to regulate by law. And some people out there will sell it, and others won't. Where I think this sort of approach of corporate social responsibility, more than pricing, but corporate social responsibility, the way I see it, is if I have a business and I want to make money, and I have expertise in drinks, but I know, because I've thought in this way, that this particular product, either that I'm selling, I mean, I've inherited my dad's company, and I know, there are these consequences. We're making money, my family depends on this, et cetera, but I know now that for a lot of people, this is not good stuff. What do I do? Well, can I modify the product? That's one option, right? Can I add, what usually we do is we add an educational component, right? We got some warning label on it. Not if you're pregnant, don't take this medicine, right? The drug ads on TV you see all the time, after they try to get you to buy it, then they say this will cause heart attack, stroke, cancer, all these kind of things. Talk to your doctor before you use it. So there's an educational side. My thinking is, and this gets to another issue about pricing, which is, do you go for commodity pricing or do you go for value added? So my recommendation is you try to go for value added pricing, which means that product actually is good for somebody. Now, if that means you have to go out of business, I would say you probably ought to go out of business. Because if you add all these things up, it's just not worth it for a small niche market to sell something that's not good for people. Yeah.
Really short follow-up. Sorry. So then, I guess you as the business owner then is kind of like making decisions for everyone else. It's like you're saying that, oh, okay, I have the soft drink company, but nobody else can make this decision to stop drinking soft drinks on their own. It's like you're saying that you as the business owner is responsible for
what you do.
for limiting the soft drink consumption.
Right, for you.
Okay. That was
Right,
just
and
a
there are other
clarifying
issues like
question.
what about all those people who continue to want to drink bad soft drinks? And they will go to your competitors, and you will lose those customers. Now, the way our society has tended to work, and now it's the global pattern, since the beginning of the Industrial Revolution, is there's sort of a scale thing, which we saw happen with tobacco in the 90s, right? When a sense of the harm or the externalities, well, the tobacco movement, the environmental movement starting in 72, really, right? When the people in their political capacity, when they feel that a particular product or a way of processing has too many public bads, basically they organize politically, they go to government, and government passes a law and says, stop, don't do that. When the railroads were abusing their power in the 1880s, people got together and they had the Interstate Commerce Act, Interstate Commerce Commission to regulate rates. When people were worried about monopolies in the 1890s, they got together, they passed the Sherman Antitrust Act. When the stock market collapsed in 1929 and people suddenly realized that there had been, the toxic quality of many investments was worse than what we had this time around, they went to the government and they passed laws about the Securities and Exchange Commission, roughly speaking, saying you cannot sell securities in the United States unless you tell the truth. You have to disclose all material and not hide material factors. So at some point, the outer limit here is the state steps in. What we're also talking about here is sort of a mid-range of should there be self-regulation? Should you, as a matter of some notion of responsibility, of knowing the consequences of your product, should you restrain yourself and try to shift your business model or give up? And my argument is that there can be a case when that is the appropriate thing to do. But people are going to argue over that, right? And some people might say, and there are a lot of people who say, look, it's up to the customers. They're over 21, they're mature. If they want to do stupid things, that's up to them. I mean, listen to the defenses that come up from tobacco companies, liquor companies, gun companies, right? And what I hear a lot is, well, it's up to you guys. I mean, you want to do this stuff? I'm not being a moral judge here. You've got money. It's a free country. You want to run the risk of having a gun in your house, which your 4-year-old kid is going to get and take and shoot his brother or sister? That's your problem, not my problem. I don't want to go to the extra cost of putting a trigger guard on this gun so that, you got to turn the key because, you're not going to want to buy that kind of a gun.